Hey guys, Rory Cummins here with Building Wealth with Real Estate. And today I'm going to go through something that I get asked a lot about. Creating passive income and most importantly, eliminating debt in the process. This actually was an inspiration for me to put this video out because I had a friend of mine that actually had this exact situation. This is an example with real numbers from her situation where she didn't have any passive income. She had existing debts and she wanted to eliminate that over the course of 2 or 3 years. And as we dug into her situation, I realized there was an easy way for her to get this done in a much quicker fashion. So hopefully this can relate to you. This is mainly a strategy that a homeowner could use or an investor that already owns real estate. And I'll walk you through it. So again, the goal is eliminating debt and generating passive income, okay? The assumption is you've got some equity to play with. So I'm going to go through this. So this was her exact situation. Currently, she had a $35,000 personal loan. She had $305,000 on her first mortgage on her house, and she had $45,000 for her second mortgage. She had zero passive income. Her home was worth $700,000 and her credit was bad. So she was thinking she had to pay the personal loan off first, and then she would basically either tackle the second mortgage and knock it out, or that she had to wait a long time to get her credit repaired before she could actually refinance this house to pull the equity out. So I told her, why not just refinance in the next 3 to 6 months? Fix your credit, refinance with a new loan on this amount after you're getting an appraisal, leave 20% in, which is what the bank wants, and then use the proceeds to pay off this. It also pays off this, and then you'll have excess amount to be able to handle the larger payment, but then also reinvest what's left. So that's what we're going to do. So here's the process. In 3 to 6 months, you build and improve your credit. I'm not going to go through the details on that. You guys can watch plenty of videos, or you may already know how to repair your credit, but it's not a year or two. It's typically 3 to 6 months. And I don't know where she was in the process. She may already be further along. She might be able to do this in 2 or 3 months. Avoid any new debts. As you're waiting to refinance over here, don't go out and get a new car loan. Don't go out and do something dumb and add new debt onto your, the lenders use a debt to income ratio, which is called a DTI, right? So you don't want to add anything that's going to skew those numbers. So just keep it clean. Prepare your house or your investment property, whichever one you're trying to do this with. Just prepare it for a good appraisal. The more money that you can get on the actual value, the better, the more you can pull out. So that could be landscaping, painting the inside, anything and everything that you can do basically to increase the value when they come out and actually do that appraisal. In the meantime, you could be shopping your lenders. You're going to want to get the best rate possible, obviously, but at the time of this video, rates are around 6.75 up to around 7.25. Still doable to do the strategy. But you'll want to kind of talk to different lenders and have your lender picked out as you're building your credit. And then you also want to know where you're going to put that money. So at the end of this process, and you're reinvesting the proceeds, all you want to do is beat the bank. So what do I mean by that is, if you're refinancing at 7%, as an example, you want to invest your money for 10%, 12%, whatever you need to do. All you got to do is beat the bank, and you're going through this process, and it's going to be a win-win. So here's at the 6 to 9 month mark, right? You've built your credit up. You go ahead and schedule your appraisal with the lender that you chose. You go ahead and refinance it. And as you refinance it for $700,000, you're going to end up with a new loan payment. After you leave 20% in, your new loan balance is going to be $560,000. I'm going to show you the math in just 1 second. And that basically pays off these 2 mortgages. So let's go over to the math really quick, and then I'm going to flip back over here and we will pick this up. All right, so here's the math. You've got the home value at $700,000. You're leaving in 20%, which means your new loan balance after you've refinanced it is $560,000. You're going to pay off the first mortgage of $305,000, the second mortgage at $45,000, and you're probably going to have closing costs around $10,000. That actually might be less, but I just rather be conservative. So in total, you're paying off $360,000. You end up with $200,000 in cash out refi. Make sense? Your personal loan was $35,000, if you remember on the back side of this. Remaining to invest is $165,000. So again, why wait and pay off that personal loan and then start saving for passive income? You could knock this out in 3 to 6 months, end up with $165,000 in your pocket. It all depends on what your numbers really are, but at 10%, that's going to give you $16,500 for the year, which is equivalent to $1,375 per month. When you raise your payment from where you're at now with these two loans to the new loan payment, your mortgage payment is going to go up, but you're only going to end up with one payment instead of two because this rate was probably lower than the second mortgage rate. And you had a personal loan that also had an interest rate. So when you combine these three payments in total, it's not going to be an apples to apples of what the increase in payment is going to be. You're still going to be paying more with this higher balance, but all things being equal, if you can get this at a good rate as well, it's going to be even lower. But the idea is the $165,000 that you reinvest at 10 or even 12% is going to beat the increase in payment, and then you'll have a remaining amount to then reinvest with, right? So let's go back to the other side really quick and I'll walk you through that. All right, so we just went through the math. This is where we're at. You end up with $165,000 and you're going to reinvest those proceeds into a passive income asset. Now, don't want to get into the whole details about where you're going to put that money. On this channel, I'm going to be going through all sorts of different investing strategies and other things that you can do to get 10, 20, whatever your percent wants to be, right? But all intents and purposes, you just need to beat the bank, right? Let's say your rate 7%, you reinvest your proceeds at 10% or 12%, and once you've paid off the additional increased payment, you're going to reinvest the remaining of that money to basically generate passive income. So let's say your payment's $1,300 extra and you've invested this money at 12%, you're going to end up with about $300 or $400 extra in passive income. So there you have it. You paid off the personal loan, you paid off a second mortgage, you now have one mortgage at a higher balance that you've eliminated debt with, and now you're able to get passive income on top of being able to cover the new payment. So everybody's numbers are going to be different, I get that, but this is a great way to get debts paid off, use the bank's money at a lower interest rate, reinvest it for passive income, and come out ahead. Because don't forget, you're still getting equity pay down on this larger balance, you're still getting tax incentive and everything else you're going to get from the ownership of that property, but you're able to get passive income way quicker than trying to pay this off over time. So hopefully this helps you guys. Leave a comment, let me know if you have questions on this strategy, or if you use this strategy and you want to give me a win, I'd love to hear about it. I have successfully done this many, many times. I'm getting ready to do it again on different properties that I own because, again, why leave a bunch of equity in a house if you can reinvest it at a higher interest rate? That's essentially the strategy here. And again, if you have bad credit, no big deal. Get it fixed and get this done so that you can do it. Now, I will tell you the one thing that you want to do is make sure that your regular income or whatever you're going to use to qualify at the higher amount is accounted for. So in other words, if all of a sudden you stop earning normal income, the bank's going to say, well, you can't afford the higher payment at the loan balance of, let's say, $560, right? So you got to take that in consideration to make sure your income is still stable and can handle a little bit more before you're able to do this. But again, you're not increasing your payment that much. So just keep that in mind. And if you want to subscribe, I'm going to be putting out more videos just like this. And like I said, we'll be going to other asset classes and talk about where you can invest this money. So hopefully that helped. See you guys in the next video.